Hello, welcome back to another episode of Litigation Speaks. I'm Richard Claywell, and I want to talk to you today about related party business expenses in a divorce case and how that works. We recently had a case, and really I'm going to be talking to you about a case study because this is what actually happened in this particular case. As a forensic accountant, what we want to do is go through and examine the financial records. So we get pretty meticulous about this. We're looking for every little detail that's out there. We want to identify issues that we think are either personal items or something that does or does not belong in a specific company. And that's what we have with this particular case. There are multiple Schedule Cs. But what this guy is doing is he is paying expenses out of I would call it a primary company, but these relate to other companies that are out there. And what's happened is, as time has gone by, those expenses have been fairly high. When it comes time for him to file, I don't remember who actually filed for the divorce, but his revenues dropped from about $400,000 a year down to $64,000 a year, which is kind of suspect in itself. We obtained 5 years of financial information, and we were engaged to look at the anomalies on how the expenses were recorded. We were not asked to do anything else. We were not asked to determine what his compensation was. We were not asked to determine what the value of the business was. It was just do the analysis and find out how the expenses are being recorded on the books and records. In the oldest year that was out there, there was the total expenses for that year were $328,000, and I've rounded these numbers up for you just to make it easier. 98% of those were related party transactions, which means in the primary company they were paying expenses for other companies to the tune of 16 companies. So what that does is it drives the profit level of the primary company down. In the next oldest year, the total expenses were $412,000. The related party expenses were $407,000. That's 98% of all the expenses. So this happened for a 5-year time period. And the final year, the total expenses, were $64,000. The related expenses were $47,000, or 73%. So it appears what's happening is he is taking these expenses and diverting those to these other companies. He's also taking his sales and he's diverting his sales into the other companies also. We were never able to get that information from discovery to see what was going on. The attorney in this case is kind of interesting. She had never done a case that had involved businesses like this before. She was completely in the dark as far as what was happening. Explained it to her, told her we need some additional discovery to find out really what is going on. We never received any more information than the initial discovery request. What's happening is the case was actually settled, and the lady is going to get around $1,000 a month for support. And in Texas, she'll get that for 60 months, 5 years. The problem is if you look at his quote primary company, and he made $40,000 a year off of that. If we could have accounted for company number 2, then that would be another $40,000. So his total income would have been $80,000. So their agreement, the settlement agreement, would have been based upon $80,000 versus $40,000. So now what about company number 3? Assume that it made the same $40,000 profit. And we don't know that because we never received that information. And the settlement would have been made on $120,000 versus $40,000. And it goes on and on and on. to the point where if you do that 16 times, it gets to be a sizable number. That doesn't mean that every company made 40,000, but more than likely, the total income for this particular family was more than $40,000 a year. So we were not invited to go to any settlement conferences that these people had, and that's their choice. But I feel that if the forensic accountant, i.e. us, would have been invited to the settlement conferences that they had, then the soon-to-be, or the ex-wife now, would have received a larger settlement. The problem is she's going to run out of the settlement agreement in 5 years, and she's not going to have any income coming in. So the gist of this is, when you have a complex tracing that needs to be done, and you've got multiple businesses that are out there, I would suggest that you have your forensic accountants go to the conferences where you're talking about the settlement agreement. My guess is most attorneys don't understand this very well. I'm not a lawyer, so I'm not going to practice law. So if you don't understand this stuff, then get some help and do this. That will benefit your client dramatically. So I hope you enjoyed this. If you have any questions, feel free to contact me. Be more than glad to discuss this with you. And would ask you that you subscribe to Richard Claywell at LinkedIn. Where also we have multiple podcasts like this that discuss a lot of different issues that are pertinent to attorneys. That's at Litigation Speaks on YouTube. So take a look at those. And again, if you have any questions, feel free to give me a call. Thank you for watching. We'll talk to you later. Bye.